Hey everybody, this is Pokey's Revenge. I am back. It's been a little bit. I know I've slowed down pretty hardcore here because we have the Florida trip coming up. So our in-person live trading workshop, seminar, whatever you want to call it. It's a 3-day event. It's in Florida. It's going to be crazy, and we leave this weekend, so I have to do a lot. All right, so today's episode is going to be a little bit complex, but I'm going to try to make it as simple as possible. So kind of the first concept I want to teach here is going to be position bracketing. So one of the members on the Rex Riches team asked this morning, like, what do you want to do with your profits, or how do you treat your portfolio as it scales up or down, right? Because we have to prepare for both. And what I have here, don't pay attention to all this stuff. Just focus right here on this first block here, this $2,000. Let's just say, for example, in a scenario here, we're using $2,000 for speculating, and of course that assumes that we've still got much more than that sitting on the side for the passive income, the dividends, the covered options, all that good stuff is already growing in the background. We've decided that $2,000 is what we're going to use to speculate with. So we take that $2,000 and we set it aside to speculate. And that's it. We don't add anything else into the mix. We don't, change our commitments. And once we're in, we don't sell off our passive income stuff just to speculate more. We use what we have. And then as we make consistent contributions, that amount will go up. If we decide to allocate portions of it to speculation, if you just want to start with a fixed dollar amount and see what happens, this is for you, right? So what I like to do is I like to view things in terms of ranges or blocks. So if you're somebody who's familiar with like zone trading, for example, say, looking at NEO, right? You're gonna want to trade between like $8 and $10, for example, right? If that was your range, that channel there back in the day. Your zone of action essentially is going to be just off the $8 level and just below the $10 level, because that's where you want to catch those moves, right? If it drops below $8, that changes the game plan a little bit, so you have to adjust, and it's just a different set of rules. So our position management, our portfolio allocation stuff should all be a similar concept, right? We want to be able to scale it up, scale it down as the profits come in, as the profits leave, so that way we're not necessarily confused or trying to adjust on the fly, right? So we can call all this out ahead of time and then put it into practice on simulated accounts, real accounts, small amounts, whatever you guys want to do. I can't tell you legally what to do. But let's just say, for the sake of demonstration, I have $2,000. I want to speculate with it. What am I going to do, right? So normally we know we can break that up into 10% trades or whatever allocation you want. In this example, I'm going to use 10% per trade with a 20% plus or minus, okay? So $2,000, if I'm using 10% per trade, that gets me 10 trades at $200 a piece, okay? That's pretty much what I'm using on the small account anyway right now. I just use $200. When the account grows, or when the speculative amount specifically grows by, 20%, right? In this case, that's a $400 level up, essentially, right? So when the speculative amount reaches $2,400, then I will shift the bracket a little bit, right? So we're at $2,400, which means I still want to use 10% per trade, okay? That's a constant for me. I just always use that. And that's going to take my position size from $200 up to $240, okay? And then, the next bracket up is, 2,400 plus 20% is 480, right? So 2,880, right? That's the next kind of zone of action. I don't have to adjust my position size until it gets up there, or if it gets down below 1920. So we're going to kind of block it out. And you can round these up if that's easier for you, or round them down. So you could just stay at $2,000. Whatever your preference is, right? And, this is just kind of a rough range, so feel free to just round it up, make it pretty. Could be 3,000, could be 2,000, doesn't matter. This could be, $500, whatever your specific preferences are. So either way, once we're at $2,400, okay, so we've grown the account from 2,000 up to 2,400. I'm still using 10% per trade, but that 10% is going to change. And I don't mean 10% of, let's say I'm at 2,250. I'm not going to use 10% of that. I'm still just focused on this $200 amount until the profits from those $200 trades bring the speculative amount up to $2,400. I guess that's probably the clearest way I can explain that. If you want to scale it and just do a raw 10%, you can do that. The math just works out a little bit better if you do it this way. And I'll explain why in a second here. So we're at $2,400. We're using $240 now. So we're increasing our position size by 20%, right? And then we know that, if the portfolio grows from 2,880, we have to scale that up again, right? We redefine what that 10% is based on. And then if it goes down below, below $2,000, down to 1920 or whatever your numbers are, we're still using 10%, but it's going to be this 10% instead of this one, right? So think about this as like a tier 1, okay? And then if the price goes, the value goes up, we unlock the tier 2, right? And so on and so forth, all the way up, all the way down, right? And we can do the same thing to the downside, right? So if we start at $2,000, we drop 20%, we're down to $1,600, right? Still going to use 10% per trade, but that scales down to $160. I don't know why I had $200 there, sorry. So our portfolio value then would be the speculative amount would then be $1,600. We're using 10% of that, so $160, until the profits or losses from that bring the speculative amount up $320 or down $320. If it goes down, we again reduce. 1,600 minus 320 is like 1,280 or something. Then we use $128 per trade because it's 10% of the 1,280. And likewise to the upside, 1920 goes up 10%, it's $192 per trade. It gets a little bit confusing with all the numbers in the mix, but just understand that we're starting at a level and we have a fixed area where we want to maintain consistency, right? And that's your trading range, that's your familiarity zone. For me, it's 20% up, 20% down. That's just what I prefer. Within that, I just use 10% of some locked number. In this case, it's $2,000. So if I make, let's say I make $100, right? The speculative amount goes up to $2,100. I'm still just going to use $200, right? Because it's based on that $2,000. It makes the math a lot simpler if I know exactly how big my positions are going to be every time I take a trade, until the amount grows or shrinks to these two numbers. Okay, that's kind of what I'm getting at here. All right. So let me close those out, and I just want to introduce this concept is a form of Zeno's paradox. It's the arrow, which can be represented mathematically. It's just infinite scale down so that we protect our risk. So essentially what we're doing here, right, is we're taking our winning, right, and we're increasing our risk exposure in a healthy way, right, because we're locked in that range. Okay, we're still doing disproportionate profits to losses, all that good stuff, all the risk management's still there. But as the portfolio grows, we're efficiently scaling up, and we're also efficiently scaling down when we lose, so that we'll always have something to play with within the speculative realm, because it's basically what it is, it's playing. These shouldn't make or break anybody, but this will drop down to 1280, and then it'll drop down from there 20% of 1280, and then from that number it'll drop 20% of that number. So you essentially have these infinite levels that you can break this down further and further and further. So what happens is, as you're winning, as you're growing your portfolio, when you develop that consistency, you've mastered risk management, your portfolio will grow, your position sizes, and therefore your profits will grow. Your losses will also grow, but they'll be outweighed, if you're consistent, by your profits. So in theory, this just scales up infinitely. That's not where most traders start. Most traders start losing, right? And this is where people don't protect themselves. So if you put a system like this in place, and I know it's a little bit confusing, a little bit complex, then you will have an infinite pool of resources, essentially, as long as you don't get down to like $1, right? And if you're making consistent contributions, eventually you get to the point where the contributions are outperforming those losses anyway, because they'll be so small and insignificant, or you just won't be able to take trades because you're not going to be trading stocks that are 80 cents if you got to buy 100 shares. So it's just a way to keep you from forcing yourself out of the market at the end of the day. So if, again, just a real quick example, I start with $2,000, I'm going to use $200 trades until that value, that $2,000, either grows to $2,400, or if it drops down to $1,600, at which point I'm going to change the position size down to 160, or I'm going to start using 240. Right? And then I'll redefine the bracket, move on, right? It just scales up, scales up, scales up, scales down, scales down, scales down, okay? So this kind of infinite scaling works for us to the upside and the downside, but mostly to the downside because it protects us, because when we're taking losses, when we're not consistent, those losses get smaller and smaller and smaller, even though there's the same ratio for our portfolio size or our speculative amount specifically, they get smaller. So it helps us, right? Because that passive income is going to keep growing. And if the speculation doesn't keep up, or if it suffers, it's not going to break you because those losses just get smaller and smaller and smaller. So it's pretty cool if you think about it, which kind of leads me into the next piece of this, right? So if we think, I guess the best way to explain this is the way that it was explained to me when I was young, and that is to think of a magical coin, okay? And the reason I'm going to talk about this is because this is essentially what we do as traders, okay? So let's just, I'll just put my camera on you guys can see my face, right? All right, so think about it this way. You've got a coin, okay? This coin can be heads and tails at the same time. It is a magical coin. There's no, like, it's not locked in yet. It's just kind of infinitely toggling really, really fast. Nobody can detect it. It's heads and tails, but it's neither at the same time, okay? This, in the realm of like quantum physics, for example, is known as a superposition, right? And I don't want to make this super complicated, so I'll just stick with the coin analogy because that makes sense, okay? So, in essence, that coin, that can just be whatever, right? It's one of two states at all times. That is our trade. Every trade we get into can be a win or a loss at the same time, right? We don't know the end result. We don't need to know the end result until we realize it, okay? And then it becomes real, okay? So if you think about this magical coin, right, and you put it inside a jar and you seal the jar, okay? That coin can infinitely flip. It can just be both at the same time, and nothing outside that jar is going to influence it. Not your hopes, not your prayers, not your dreams, not how much you want it. You can't will it into submission to be a head or a tail, just like we can't will our trades into being winners or losers, right? Our goal isn't to predict. It's not to try to force things to be a certain way. Our job is to manage risk and mitigate losses, okay? Which is where our friend the coin comes in. So if and when you open that jar, okay, the air comes in, and the more that coin's exposed to air, the more real it becomes, right? We're observing it. It's becoming a head or a tail, right? It's starting to slow down that oscillation. It's becoming a coin that's either a head or a tail, and that's a defined outcome. And that process, right, that external influence forcing something to be one specific thing, that is a term called decoherence, which is a very complicated, if you're new to like philosophy or if you're new to quantum physics, that's a pretty complicated theory. But if you think about it, it's basically just an advanced form of Schrodinger's cat. So Schrodinger's cat obviously is the cat in the box, the atom decay, and the cat's alive and dead or neither, right? So decoherence is more about how external influences kind of force things to be one, or a classical state, as it's called. So something that we see in the real world, okay? So I know I've gotten a little bit off the rails here, but it's a complex and interesting topic, and I want to explain it because it applies directly to trading, okay? And I'm just asking you to trust me here. We're 12 minutes in, and I'm crazy. So, okay, so we got the coin, we got the jar, we open the jar, right? We pull out the coin, and it's either a head or a tail, okay? That is our trade. Every time we enter a trade, coin goes in the jar, right? We take our money, that coin, put it in the jar. Okay, we seal the jar. That is us being in the trade. We're not taking action until it's either take profit or stop loss. Okay, so it's one of those two defined outcomes, but we don't know which one it is. We don't need to know, all right? It's just doing its thing in that zone, right? And then one of those levels gets hit. The jar is open. The air is in there. It's I think I explained it earlier as the scene from Back to the Future where Marty McFly is trying to get his parents together and he starts fading and stuff like that. And that's kind of what happens with one of those states, or the profit or the loss. Whichever one doesn't happen, it just kind of dissolves and it gets pushed into this state of being real, which is either a profit or a loss, whichever one actually happens, okay? And that's essentially what decoherence is. It's just the possibility of two states in a superposition, right? So again, just that state of being either one or both, being forced to be real as the one that's observed. Okay, so again, I don't want to get too philosophical here, but just think about it in terms of trading. When you enter a trade, you don't know what it's going to be. It's both, right? It's a profit and a loss. And when we observe it, when we realize that profit or loss, when it hits a target, when it hits a stop loss, it becomes real. And that is when, that's when the jar is opened, and that's when we have our end result. So now the direction I'm going with this is that we can change the rules, whereas you can't so much in quantum physics because rules are rules. You could just make more rules, right? But in the stock market, we can take that concept of saying, okay, it's going to be one of these two no matter what. And because of the decoherence, external factors kind of influence it a little bit. You know, you get that bias, but it's going to be one of these two end results, okay? And instead of taking out, let's say it's heads, right? What if we could pull out two coins? Okay? If it's tails, we still just pull out the one coin, right? We put one coin in, we pull one coin out. You know, it's a magic coin, so it's got its own little properties. But every time it's a head, right, we can pull out two coins, make more money, right? So if we think about this in terms of profits and losses, if we get a profit, right, that's a head, all right, we're making twice as much as when we lose. And that, in turn, changes the decoherence, if you will, of your portfolio, right? Because what you're doing is you're You're taking an external factor, an external influence, which is the stock market and your trading, and you're using it to force the state of your portfolio into one state, which is growth, okay? So if you're making twice as many profits, minimum, right? Because you can always make like 5 times, whatever, but if you're just safely making twice as much, and every time you lose, it's just a small, consistent amount, it's predefined. It's going to be one of those 2 outcomes, right? You're winning more or you're losing less, okay? If you do this across 10 trades, okay, and you document those trades and you change your mindset so that you're focused on those trades being successful instead of just being profitable, meaning that you've done it consistently. You've run down your full checklist, every single box is checked. You don't have anything to diagnose. You didn't deviate from your plan. You're going to have wins, you're going to have losses. You should be net profitable, right? If you're not, that's just a matter of optimizing that trading plan a little bit, trying to, fine tune some triggers and things like that. But overall, you should be pulling out 2 coins every time it's heads and 1 coin every time it's tails, and you should be net profitable, right? So if you do that across 10 trades, take 10 more. Make sure it wasn't a fluke, okay? And this could be practice. It could be a real account, small position, whatever it is, right? Ultimately, our job is to minimize risk and to leverage probability, okay? And that's all we're doing, right? You can flip a coin, buy a trade, sell it, whatever, right? That's all. You don't control that stuff. You can't control any of it. That's not your job. Stop trying. You're going to hurt yourself. I did it. I hurt myself. So everything we do should have this kind of approach, right? Every single factor of my trading plan, for example, and the strategy I've been teaching has decoherence kind of built in, because that is it's tipping the balance in favor of pulling out 2 coins instead of 1 every time I trade. It doesn't mean it's going to happen every single time, but it means the probability is much higher, and that's why we just kind of do things like technical analysis. First, it identifies risk so we can minimize it. Second, it identifies bias factors, right? When you open that jar, you can make sure that you're opening it in a place where the air is hot or cold, if that's going to speed up or tip the likelihood of that magic coin. Let's say you understand the coin's properties, right? And you just know that if it is exposed to hot air, it turns into a head more likely. Or if it's cold air, it turns into a tail more likely. So you know where you can open that jar, where you can put the coin in the jar, close it, bring the jar, whatever, wherever you want to bring that analogy. Your role is just to line up as many factors as you can without going crazy, for the higher probability of you pulling out 2 of those coins at the end instead of 1 coin. All right, that's all we're doing here. That's all decoherence is. So for the 20-period moving average, for example, the strategy, right? We're making sure the moving average has a positive slope. The trend, okay, the price action itself is already experiencing decoherence, and the fact that it's going up. It's being forced into a state by the trend, the momentum of that price action. All we're doing is catching a piece of that, right? So you've got the trend already going in your favor, okay? You're trading when the price is above the moving average, so it's higher than average, all right? That is also a form of bias. You're minimizing risk, which means that your likelihood of success should be higher overall. You're making sure that there's good volume, right? More people are participating. They're seeing the same thing. They're motivated, right? They're willing to throw money at it. But you're having tight risk, which gives you the advantage. So you don't have to worry about it selling off 60% and then trying to figure out, where's the next point of bias, right? Because it's stressful. So don't do that to yourself. It's going to hurt. But I wanted to talk about the Zeno's paradox first, because that helps protect us on the way down. If we start to lose, if we struggle with consistency, we start losing overall, this protects us by keeping us in the game, because it reduces the amount we continue to expose to risk. So if I'm on a $2,000 portfolio and I drop it down to $1,700, I'm just still going to use $200, because that is the zone that I'm in. I could use 170 and I could still see some results, but the math and the psychology behind it just help better, because I'll get more consistent results if I'm trading with the same position size until it's time to transition up or down a bracket. Okay, so that's one concept. Okay, and the next concept is the whole superposition, decoherence, bias stuff. Right? You don't have to understand quantum mechanics here. What you do have to understand, though, is that trading will only ever be one of 2 results. It's either going to be something you make money on or something you lose money on, all right? And I'm referring to individual trades and the whole process, okay? If you are losing money overall, you can scale down, right? You can use the tools, the system, right? The structure here that I'm giving you guys, not blindly copying it, of course, but you guys can use the concepts here, right? rather than lose, let's say you lose 10% every trade, you can't get something figured out. You always end up losing 10%, right? So if you're trading, $200 a pop, you lose $20 a pop, $20, until you get down to $1,600, okay? And then you change your position size and you start losing 10% of that. So you lose $16, $16. Then you lose $1.60 off that price, and then you reduce that by 10%. Down and down and down, your losses get smaller and smaller and smaller because your position size gets smaller and smaller. Now your profits do as well. However, those will scale up and continue to scale up and continue to scale up much more effectively and in your favor specifically because of the way that this is structured. So I really hope that makes sense. It's just how the math works. It's pretty good. I like it. So back to my face. And as far as the superposition, the coin, right? Because I don't want to make this like a physics lecture or a philosophy thing. It's all about mindset, right? Your mindset is what makes you a successful trader and your ability to execute, okay? It's not about being right. And it's not about having the perfect strategy. Your job, again, just to kind of reiterate, because I'm going pretty far in this one, and I want to make sure everyone understands this stuff. So don't worry about the words. Don't worry about what superposition is or decoherence or anything like that. What I want you to focus on is the fact that you don't control anything other than your risk exposure, right? You don't pick whether the stock goes up or down after you buy it. You just control how much you put in, when you put it in, and when you pull it out, and how much extra is there when you pull it out, or how much is not there when you pull it out, meaning you've taken a loss. So if you do it right, you'll have a loss this size and a profit this size every time you take a trade. There'll be one of those two defined outcomes. And if you want to be a real mechanical trader, you can incorporate something like the 1% rule, which means that you take whatever your amount is, right? Say I have $2,000 I want to trade with. I take 1% of that, that's $20. I'll make sure that my risk range only allows me to lose $20 on that trade and every trade within that range. And then I know for a fact my loss will be $20 and my profit will be $40. So there's two specifically defined outcomes. I think I have a video on the 1% rule. If I don't, I can make another one. It's just a little math thing. You can make a spreadsheet, or I can just give you one. I don't care. And then that way you've got this exact end result here, where you've got predefined outcomes and you've got predefined disproportionate profits and losses. Okay, so in this case, I show a 20-cent loss, 40% win on these on $20 trades. That's the 1% rule in effect. All right, so every single one of those is going to eventually add up throughout the day to one of these 6 predefined outcomes if you take 5 trades, for example. So won't get too far into the weeds there, but just understand that this is just a numbers game at the end of the day. You don't control anything. It has nothing to do with guessing. It's got nothing to do with being right or having an ego about it. Just like, I don't care how successful you are as a trader. It's not because you're right all the time. You won't be. But if you are a successful trader, and this is typically the type of trader that we don't see showing off on social media, don't see bragging about everything, and don't see, just shoving stuff down people's throats, is because you've focused on your risk management and consistency. And that's really what it boils down to. And I say less is more. I got a couple catchphrases that I use in the Discord all the time, but it's all the same stuff, right? I haven't said anything new in like 3 years here. It's all the same stuff. So maybe it takes hearing it one more time, in which case I'm happy to say it. That's why I do this, because I want you guys all to find success. But it's really just about making sure that you are first putting magic coins into that jar, okay? Make sure that you're looking for high quality setups. Make sure you're using consistent position sizes. And when I say this, I say make sure, blah, blah, blah. That is a command form. I can't legally say that, but I can talk to my old self, and this is what I'd say to my old self. SEC, I love you. Don't come after me, or FTC. Make sure you're using high quality setups. Make sure you're using consistent, responsible position sizes. Make sure you have some structure in place. And then when it's time to seal the jar, you have to make sure it stays closed. You can look at it. You can watch the magic inside. You can kick the jar across the yard if you want to. Nothing outside that jar is going to influence it, right? It's already done. It's factored into the coin itself, right? It's all internal at that point. You don't control it. When it's time to open that jar, you make sure you open it. And what you pull out of there should only ever be one coin that's real, or two coins that's real. So 2 if it's a win, 1 if it's a loss, 2 or more, I should say. If you're pulling like a 10 millimeter socket out of that jar, if you're pulling a boot out of that jar, you've abandoned your intent. Okay, most people start trading for a specific reason, and most people understand that it is not an overnight thing, and that there's big risk and stuff like that. So most new traders tend to minimize that risk. Like, oh, I'll buy a share, right? And that's probably most of the people watching this video. They started out like that. I started out like that. And then things get out of control pretty quick, right? We start buying all kinds of crazy stuff. We start holding things. We start building bigger positions. We throw more money at things. It's all just part of the process. And ultimately what you want to do is just get back to that spot where it's just you in that jar, right? You're putting a magic coin in, and then you're pulling 2 coins out or 1 coin out. Right? You don't want to pull out rubber chicken. There's nothing in that jar or in that magic process that should be a rubber chicken. You shouldn't pull that out of a jar. It should always be 1 coin or 2 coins, or 1 or 2 or more, I should say. Some number of coins greater than 1. Okay. So if in your trading you find that you're pulling out all kinds of stuff, if you pull like a Dr. Pepper bottle out of that jar, something is wrong with the way that your trade is being executed, okay? Or it's the way that it's set up, right? Because remember, once you're in, you don't control anything. The stock market goes up, the stock market goes down, okay? Based on that, you should only have 1 coin or 2 or more coins, right? You shouldn't ever have any process between here and there that results in a Dr. Pepper or a rubber chicken or whatever else I said. I don't know. I don't know. I got random stuff laying around. So this is why it's important to keep things simple, keep it small. And I know this is a super complicated like quantum physics lecture thing. It's really just about mindset. So this is one specific example where it really defines our job as a trader and our role in the market into one word, and that word is decoherence. So go out and manifest that. Like that's all we do. Again, we want to make sure that everything we do has risk management baked in, every single step, right? There's not a single thing that I do that doesn't have risk management baked in, okay? I allocate my portfolio responsibly. Most of my money's in passive income. A small portion of it's in speculation because that's the higher risk stuff. So bigger chunk of money, smaller risk. Smaller chunk of money, bigger risk. It balances out nicely if you do it right. When I'm in trades, I make sure I use responsible, consistent position sizing. That way I have defined outcomes. Everything's in a familiar range. If I grow my portfolio my speculative amount from $2,000 up to $2,400, I might not want to trade with $2,400. I might just trim that $400 off and throw it in the investment side and just stick with the $2,000 that I started with. It's still going to be $200 trades. It's still going to be familiar ranges. The math won't change. It'll be nice. But what I've done is I've taken $400 and I've locked it in, and it's going out and working for me on its own. I don't have to work twice for that money, right? It's going to get dividend money or covered call premium or whatever strategy I use, right? So that's the idea. So not everybody wants to scale up. Not everybody wants to, make millions on the speculation stuff. If you're just looking to feed into the passive income stuff, that's an easy way to do it. But eventually you will probably lose some money and you'll probably go down to the next bracket. It's going to happen, at which point you'll just repeat the process. Maybe then you do stay up to 2,000. If you're at 1,600, as an example, so if you move down a bracket, right? And again, your numbers are your own. I'm just using this as an example. If you're at 1,600 and you find more success than you did at $2,000, every time you get back up to $2,000, you can trim it. Try it a little bit, see if it works, but you can always trim it. And you'll find your range, right? You're going to have your own little personal support and resistances, and that's what this process is about. It's about finding what you are confident in and what you can do consistently and what you can't, and then identifying specifics to stop you from hurting yourselves on the things that you can't. So if you can't trade naked options, for example, and you constantly find yourself throwing money at them, there's an underlying item that you can look at and figure out why you're doing that. Most of the time it's like FOMO or maybe it's a little bit of greed, whatever. Everyone's kind of different. Everyone has like their own external pressures and things. It's okay. But it's an objective point of data that you can look at and say, this is not working for me, so I need to do this instead, right? Maybe you're good at doing the passive option stuff. Maybe you just prefer equity, for example. That'll minimize your risk, and that's what works, right? Maybe you want to take your speculative amount and just put it in a savings account, so it automatically gets that 1 to 3% that you're not able to achieve on your portfolio, right? And then you're still getting 12 to 20% on your dividends and your passive income and stuff. So it's still outperforming the savings account, but you're not putting all of it into the passive income, right? You still have the option of kind of stepping down that hierarchy of income that we talked about early on. Maybe you put it in a 401k instead. Who knows, right? Everyone's kind of got different circumstances. But when it comes time to trade, you got to have a plan for every single piece of it, right? If I see a specific entry that I like, I have a specific strategy, and I have a specific intent. I'm either going to stop out tight and take the loss and move on to the next trade, or I'm going to build in slowly and average down responsibly and then reduce as soon as it's at break even or above, so I can drive that average down. And that is two completely separate styles of trading, right? So if you're day trading, for example, or you're swing trading and you want to go with the trend and you got some strategy that you like the 20-period moving average one, for example. Every aspect of that has decoherence built in. Everything should be pointing up, but you can't control that. There's always chaos, right? Entropy. So stock market falls. It goes down sometimes. You got to have that risk management in place if that's your strategy and your plan, okay? If you are okay with that chaos and you want to kind of play the probability of averaging your position around, you can place a smaller buy, right? And then you can let it drop. It's okay. It just depends on who you are as a person. Not everybody likes seeing red. Not everybody likes seeing, small green, for example, right? It really just depends on who you are. And that's kind of why I'm here. I'm here to kind of help you ask yourself questions and figure that out. But if you're okay building positions down, you want to really make sure that those are pretty far apart. So you're probably going to see some big red numbers at points. But your win rate, right, which we know are kind of garbage and irrelevant, your win rate will be higher in most cases, but your losses will probably be bigger when you're forced to take them, right? So it really doesn't matter too much statistically, as long as you can pick one of those and be consistent. Like, that's where most people struggle. They try to do both, right? They try to buy a big position and then they average down on it without that being the original plan. Or they buy a small position and they cut the profits on the way up because they expected it to go down, and it just messes with their head because they're not used to things going up after they buy them. So again, just to recap really quickly, because this is a very long episode, it's over a half hour now. Bracketing is nice. This is one of the things that I personally just love, and it saves you a lot of headache. Right? So again, you start with an amount for speculation. You use some percentage of that, and you set a range above and below where you'll readdress what that position size would be, right? If it's below, that number would be smaller. If it's above, that number would be bigger. If you don't want to trade up here, right? Remember, if this grows, you have to adapt with it. And if you can't or you don't want to, you can always just take this entire chunk and just throw it over into the passive income side and not worry about it. And you'll still just be with this range right here, okay? That's what most traders do when they start is, they just trim. They use a feeder account to pass into the passive income stuff. Or I should say most successful traders. And then beyond that, just focus on that jar. Like, that jar is your trading journey in a nutshell, right? Like, the quality of the magic coin that you put in determines the end result. If you put in something that could be anything, you'll probably get anything out of that jar, right? If you put something in that can only be a profit or a loss, you're going to get a profit or a loss out of that jar. As soon as you open it, air hits it, it locks in, it chooses what it wants to be. You don't choose that, it chooses. You pull either one coin out if it's a loss, or 2 coins out if it's a win, and that's it, right? That's trading. You've done it. You've mastered it. It's very simple, but it's not very easy. And that's why it takes many years in a lot of cases for people to figure it out. And understanding that there are external factors which determine or help determine which state that coin ends up in, and then just leveraging those. Like, you can't reach in the jar and pick one, but you can tilt the jar a little bit, right? And we can change the rules for when it's time to open that jar. That's our advantage as traders, right? We can look at the system and optimize it to our favor. And that's all, like, banks do. That's all Warren Buffett did. Like, I don't personally like the guy. Sorry if you're watching, Warren, but you send a lot of really harmful messages out to traders. But he grew up in a different world. I get it. But that's all he does, right? He's just leveraging things, and that's all any institution does as well. So we can do that as well in our scale and within our role. Obviously, we don't have the budgets they do. Like, we don't have billions of dollars that we can throw at stocks and kind of move them, right? But we do understand our role, and we can understand that our risk exposure is 100% within our control, unless there's something crazy that happens, like a halt, right? If something halts pending news, can't do anything about it. We're stuck, and that's okay, right? Because that is still built in, right? So our speculation amount is always going to be small, right? It's always going to be smaller than our passive income foundation, so it doesn't really matter at the end of the day. We just take a hit, right? And we get that back at tax time. So it's not the end of the world. I don't want to see anybody hurt themselves with speculation, but that's typically what we see because people get greedy. They get that FOMO. They see other people nailing it, which is a form of confirmation bias and survivorship bias. You're seeing things that have succeeded, but you're not necessarily seeing things that have failed, oftentimes within that same person. And what's happening is those people are typically over-allocating. They take a bunch of losses, and they add more money, and then they hit something big, and then they praise it, and they celebrate it because that's their brain's way of soothing, right? They want to make sure that they reward that, reinforce it, because they want to introduce their own decoherence and try to, reinforce that habit of winning, and they just don't have the specific pathway. They don't have the same jar that we have, right? They have a different jar, and they're putting different stuff in it, right? So we have a jar. We have a nice clean glass jar. We can kind of see in it. We have magic coins. We can bloop, bloop, put them in one at a time. We have a defined outcome. We can open the jar, pull it out, right? It's one of two things, okay? So the simpler we can make it and the less involved we can make it, like I don't need my ego to be stroked by any trade. I'm either right or I'm wrong. It doesn't matter. I take 15, 20 losses and a couple of wins will outperform them in most cases, right? Because I have leverage, right? I have that magic jar. That doesn't mean I need to pull out 15 or 20 coins. It just means that I need to leverage the wins that are there and let the chart dictate how far they go. And I need to control those losses and make sure that I control my risk exposure when they do occur. Okay? So again, I know this is, I gotta end this stream. It's not about winning. It's not about being right all the time. It's not about guessing, predicting, any of that garbage that you see on YouTube. And this is on YouTube, so sorry, but I'm disagreeing with everybody here. Everyone can fight me in the parking lot. I don't care. Because they're the ones that are hurting you. Because they're saying the wrong thing. They're saying you have to be right. You have to, you have to use this strategy. You have to use that strategy. You have to pay me for this strategy. You have to buy this $2,000 course for this strategy. None of that crap works consistently across people. I can publish my strategy right now. I've shown you guys all my strategies. Well, not all of them, but I've shown you some pretty easy strategies that you guys can use and demonstrate a proof of concept. But I can give that same strategy to somebody else that hasn't had that same insight or same explanation. Just give them the rules. They'll probably fail because they don't understand why each of those rules are in place. So they can't really implement it, or they don't have the portfolio management piece of it, or any number of things. They don't have the discipline to execute it consistently from start to finish, or the ability to do 10 trades and document them all. Checklist, full checklist. Boom. Here's where I deviated. This is what I fixed. 10 more trades. Here's where I deviated, 10 more trades. And then boom, all 10 are good. Do another 10 just to make sure, and do 200 trades, right? And by that point, you should be a successful trader. But getting that first 10, 100% through, all the way down, top to bottom checklist, whether it's profitable or not, that's the challenge. And once you do something, I think the rule is like 8 to 13 times. If you can do something 8 to 13 times perfectly, it is a lifelong habit. And you've made it at that point. But getting to that 8 to 13 might take 1,000 tries. And I know a lot of people say, oh, just don't give up, blah, blah, blah. Don't give up. Give yourself permission to take it seriously, and give yourself specifics that you can use. And don't try to fill in the gaps. If you have questions, ask someone, and make sure that everything has some element of common sense to it. Like, if someone's just telling you to use 5 indicators because, it works for them, you can't use that. You can't have any confidence in that because it didn't work for you, and there's no reason for you to use all 5 indicators if you don't understand them. So make sure things make sense. Everything I teach you guys hopefully makes sense. If it doesn't, I want you guys to call me out. I want you to challenge it. I want you to ask questions. And that's, anyone who doesn't welcome that kind of open scrutiny is trying to screw you over. In most cases, they're trying to get something out of you. And I hate it. I hate it on your behalf because I see it all the time. I just can't stand like predatory gimmicks and gurus and all that stuff. So beyond my personal opinions, because we're 40 minutes in, I'm going to end this recording. Just focus on that jar, guys. Don't pick up someone else's jar. Don't even pick up my jar. I can't I can't say anything weird's going to come out of it, but it just won't work for you. It's got a little lock on it. I have the key. You have your own key. Get your own jar. I want you to build your own jar, right? That's what this is all about. You put your magic coins in, you get your magic coins out. And then those magic coins go back in. They reproduce, they make more. You take a chunk of them, you stick them over the investment big vault bank thing, and that just passively grows. It's like that room in Harry Potter where the goblets just keep reproducing. That's what I want for you guys. So to get there, we need the specifics, and those specifics are based on you as a person. I can't tell you what to do. So I'm going to end this recording. Thank you all for watching, and I look forward to Florida. We're going this weekend. It's going to be awesome. I'm going to get sunburned. So it was nice knowing you guys in my hydrated state. Yeah, all right. So I'll see you then. Thank you all, and have a good day. Bye.